Hello, my name is Braulio Welch, and my presentation is on banking regulations. In this presentation, we're going to review the reasons for the regulations. We're going to discuss the regulatory agencies that provide oversight to the banking industry. We're going to look at the target oversight elements that these regulations are attempting to address. We're going to look at historical laws and regulations from which the modern day regulations are based on. We're going to look at social responsibility acts. We're going to discuss contemporary laws and reforms to the existing laws. And we're going to look at some of the unresolved issues or gaps that the current regulations don't address. Reasons for regulations. Obviously, we want to protect the safety of the public's savings and their financial transactions. We want to control the supply of money and credit to ensure inflation doesn't go out of control and that our economy can be sustained. We want to ensure the equal opportunity and fairness and access to that credit. We want to promote public confidence in the financial system. We want to avoid concentration of power, sometimes referred to as avoiding the too big to fail institutions. And then, of course, we want to support of government activities. Some of the regulatory agencies that exist in the United States include the Federal Reserve System, or the Fed as it's commonly referred to. It is the central banking system of the United States. The Comptroller of the Currency. This agency charters, regulates, and supervises the national banks. The Federal Deposit Insurance Corporation. This is an independent agency that's responsible for insuring deposits both by individuals and companies in those banks. The Department of Justice. This is the primary federal criminal investigation and enforcement agency of the United States. Security and Exchange Commission. It holds the primary responsibility for enforcing federal securities laws. And state banking boards or commissions. These institutions oversee new applications of certification for authorization for banks within the states themselves. Some of the target oversight elements include the creation of depository institutions, things like the initial licensing and chartering, the location and number of physical branches and offices, the initial board of directors for these institutions, and establishing the minimum cash and capital requirements upon the initiation of those institutions. The ongoing operations is another primary element that is targeted by these regulations. It wants to control or dictate how mergers and acquisitions occur. It also discusses opening and closing of offices and branches within these institutions or by these institutions. It also provides oversight on the operation procedures that these institutions employ from the day-to-day operations, as well as establishing the financial services and products that can be offered. Assets. Assets is discussing the types of assets that can be handled or maintained by these institutions, the diversification of these assets, the quality of these assets, the liquidity of these assets, as well as the level of cash reserves required for operations by these institutions. Liabilities and equity. These is talking about the types of liabilities that can be created by the institutions. Liabilities referring to loans, the types of loans, distribution of the financing assets and how these loans can be packaged and sold, the quality and liability of the equity accounts, and the minimum capital requirements in relationship to those liabilities that they create. The controls are referring to the audits, reporting requirements that these institutions are required to maintain, both internally and to the external oversight agencies. And of course, some of the other elements that are discussed in these regulations target community involvement, the degree of market share in each area that an institution can maintain to ensure fair competition between the institutions, and the non-discriminatory operating policies in the practices that they can engage in issuing loans and offering certain services to the consumer. Historical laws and regulations. There are four main ones the National Banking Act of 1863 and 1864, the Federal Reserve Act of 1913, Glass-Steagall Act of 1933, and the FDIC Act of 1935. We're going to discuss these in a little bit of detail. The National Banking Act was passed during the Civil War to help fund the war. It created a new division of the Treasury, the comptrollers of the currency, and it created national banks with a federal charter. The Federal Reserve Act of 1913 was passed after a series of financial panics at the beginning of the century. It created the Federal Reserve System. It gave the Fed the authority to act as the lender of last resort. It created to provide a number of services to the member banks, and today the Fed controls the money supply. The Glass-Steagall Act of 1933 was passed during the Great Depression. It was separated investments and commercial banking. It created the FDIC. The Fed was given the power to set margin and requirements, and it prohibited interest to be paid on checking accounts. The FDIC Act of 1935 addressed the issues left out of the Glass-Steagall Act. It basically gave the FDIC the power to examine banks and take necessary action. The FDIC insures deposits, and it makes sure that anything above certain dollar threshold limits by individuals and companies are protected. And if an institution fails, those deposits are guaranteed. Social Responsibility Acts. Truth in Lending Act, Equal Credit Opportunity Act, Real Estate Settlement Procedures Act, Community Reinvestment Act, the Truth in Lending Regulation Z, and Truth in Savings Acts are some of the main social responsibility acts over the years. In 1968, the Truth in Lending Act basically ensured that full information on terms of loans must be given. The Equal Credit Opportunity Act showed that loans cannot be denied on the basis of age, sex, race, national origin, or religion. The Real Estate Settlement Procedures Act basically helped consumers become better shoppers. It required institutions to be forthcoming with their practices in real estate and mortgages in particular. The Community Reinvestment Act basically said that you cannot discriminate based on the neighborhood in which borrowers resides. In other words, you couldn't deny a borrower access to a mortgage simply because of the community in which he lived in. And then the Regulation Z and the Truth in Savings Act were targeting banks, ensuring that they must disclose full terms on deposits and savings accounts. Obviously, all of these regulations were in support of the consumer and making things fair as far as what the banks can do in their lending and financial services practices. Contemporary laws and reforms. There are many. Depository Institution Deregulation and Monetary Control Act. It was first of the deregulation acts. It phased out interest rate ceilings. It allowed interest to be paid on checking accounts. And the term transaction account created for all institutions with these accounts subject to reserve requirements. The Garn-St. Germain Act of 1982 was continued the deregulation that was initiated by the Depository Institution Deregulation and Monetary Control Act. It created money market deposit accounts. It indicated that FDIC could arrange mergers across state lines if needed. Loan limits were liberalized, and it enacted that banks in need of capital could get it from the FDIC. The Competitive Equality in Banking Act of 1987, it allowed creation of special bridge banks for the failed institutions. It enacted that bridge banks are special national banks operated by the FDIC, and that bridge banks created when bank is essential to the community. In other words, it expanded the FDIC's capabilities to ensure the financial system would not collapse. The Financial Institutional Reforms, Recovery and Enforcement Act of 1989 was created in response to a large number of bank and saving and loans failures. It combined the FDIC and the FSLIC into the current FDIC and dismantled savings and loans regulatory body. It created an RTC to take on assets of failed savings and loans. It created a $50 billion authorization to handle failed institutions. This would later be increased. And it allowed bank holding companies to purchase savings banks. The FDIC Improvement Act of 91. This regulation, it moved towards re-regulating the industry. It required that regulators to take prompt corrective action when a bank had problems, and it prompted corrective action based on capital positions of the bank. And it required regulators to develop a new standard for banks that they regulated. Again, trying to strengthen the infrastructure and the regulatory controls around the financial services industry. In 1994, the Regal-Neal Act was passed. Basically, it oversaw the Interstate Banking and Branching Efficiency Act repeal provision of the McFadden Act of 1927. It instituted the bank holding companies can acquire banks nationwide, and that it enacted the consolidation of interstate branches into BHCs into branches. Around this time, there was a lot of acquisitions going on, and this act kind of helped usher in how those mergers and acquisitions would occur. The Graham-Leach-Bliley Act of 1999. This regulation permitted banks and insurance and security affiliations with regulators as approved for all capitalized institutions. Consumer protections for consumer purchasing insurance through banks. It also established that disclosures of policies regarding and sharing customer private information. It also had protection for customers who are allowed to opt out of private information sharing. It also regulated the fees for ATM use, and that they required institutions to clearly disclose them so that consumers were not overcharged, or at least were aware of how they were being charged. And it also made it a federal crime to engage in identity theft. The U.S. Patriot Act of 2001 required that banks and financial service providers to establish the identity of their customers. This was in direct reaction to the disaster of 9/11. It required banks and financial services to provide, check the customer ID against government-supplied list of possible terrorists and terrorist organizations, and also establish the SAR reporting, which is suspicious activity reporting in customer accounts, looking for transactions above certain dollar amounts. The specific dollar amounts currently are $10,000 transactions, must be reported and investigated, and any suspicious activity should be reported on. The Sarbanes-Oxley Act of 2002, although not specific to the banking regulation, did have a major impact on the industry. It was in direct response to the Arthur Andersen, Enron, and WorldCom debacles. It seeks to restore public confidence in public accounting and publicly traded securities. And the main focus of the act was to assure ethical business practices through heightened levels of executive awareness and accountability. The Fair and Accurate Credit Transactions Act of 2003 was passed in response to increased problems of identity theft. The Federal Trade Commission must make it easier for consumers victimized to file for ID theft. And also individuals and families are entitled to free credit reports was established by this regulation. The Emergency Economic Stabilization Act of 2008 famously included the TARP regulation. It was passed in response to the home mortgage and financial system problems of the year. It temporarily increased the FDIC deposit insurance coverage from $100,000 to $250,000 for all deposits, which ended in the following year in 2009. It also allowed the U.S. Treasury to add capital to banks to enhance lending, basically forcing financial institutions to take money to ensure that they had appropriate deposits to support their operations. And in 2010, the Dodd-Frank Act was passed, and this was also in reaction to the housing crisis of 2008. It aimed to restructure regulatory framework in the United States financial system. It placed many new regulations on financial institutions while attempting to keep accountability to companies who fell during the crisis. It also added over 90 provisions that required the SEC rulemaking and gives the SEC additional discretionary power. Some unresolved issues include risk management, not really addressing the too big to fail institutions, and although there's a lot of regulation, there seems that there are not effective oversight and transparency in these regulations. Basically, it is not clear that these regulatory safety nets that have been established by these regulations actually protect small depositors or encourage financial firms to take effective measures in managing their risk. It is not even clear that if the deregulation of the too big to fail institutions were appropriately addressed. I mean, some of them are still too large and still have too much or don't have enough liquidity to support the absorbent transactions that they maintain, and the amount of risk isn't in parallel with those transactions. And of course, as these firms become larger and complex, does the government have the resources to actually provide the oversight and enforce the transparency that these regulations call for? Quite frankly, I don't think that the government can sustain effective oversight of these institutions as it currently exists. There has to be other solutions in making sure that these large institutions are held to these new regulations and they are following these rules. So that leaves a lot of work to do, and I'm not sure that with the current state of our government that it can be addressed in the immediate future, but it is something that should be continued to be worked towards. Now, I had to reference a lot of material to get the information for this file, and I tried to condense it as best I can, but I had over 20 references, which I have presented here. I really enjoyed this exercise. Thank you, Dr. Greene, for giving us the opportunity to do this. I found it very challenging, but very rewarding as well.